Hi, greetings. It's me, Dr. Paul Gerhardt, and this is the first video lecture of the mergers and acquisitions series that I'm going to present to you. There are going to be 10 videos, and each of them are going to build on each other to help you better understand from a business perspective what is a merger and an acquisition and how do they work and things to consider in order to have successful mergers and acquisitions within your organization. So hang in there. It's not the most exciting topic out there, but I'm going to be sharing some information that hopefully you find useful, that helps you build your expertise in the world of mergers and acquisitions. Whenever I refer to the term MA, I want you to remember that I'm talking about mergers and acquisitions in each of these videos. So let's get started. So let's talk about the focus of mergers and acquisitions. They're commonly called M&A, and among the most consequential strategic decisions managers make. A transition can change the size of the organization, its position, geographic reach, technology, workforce, customer relationships, financial structure, and competitive environment almost immediately. MA history is not simply a sequence of famous deals. It's a record of how corporations have responded to industrial change, new technologies, economic cycles, regulation, capital market conditions, and managerial beliefs about growth. Studying that history allows managers to recognize recurring patterns, question popular deal rationales, and avoid assuming that a strategy is sound merely because many other companies are pursuing it. So let's dive into the topic of understanding mergers and acquisitions. Simply put, a merger or acquisition combines previously separate organizations, business units, assets, capabilities, or ownership interests. Although the terms are often grouped together, they are not identical. A merger occurs when two organizations combine into one business entity. The transaction may be presented as a partnership between relatively equal companies, although one party often exercises greater control in practice. An acquisition occurs when one organization purchases another organization, controlling interest in it or selected assets from it. The acquired company may continue operating as a subsidiary, be absorbed into the buyer, retain its brand, lose its separate identity, sell only part of its operations. Let's talk about why the distinction can be misleading. Managers should not rely solely on the public label attaching to a transaction. A deal announced as a merger of equals may function economically and organizationally as a takeover. The more important managerial questions are: who controls the combined organization? Who appoints the senior leadership team? Which company's systems and culture will dominate? Which stakeholders receive control? Which employees and facilities will remain? And finally, who bears the financial and integration risks? A transaction's legal structure, public branding, and organizational reality may be different. Corporations can grow through internal development or external expansion. Let's talk about organic growth. Organic growth occurs when a company builds new products, facilities, customers, capabilities, or geographic operations using its existing organization. Some examples include opening additional stores, developing a new product internally, hiring and training employees, creating a new distribution system, and expanding into another region through internally developed operations. Let's talk about inorganic growth. M&A is an inorganic growth strategy because the corporation purchases or combines with capabilities that already exist. A company may acquire in months what would otherwise take years to develop. For example, a firm can acquire a recognized brand, patents or proprietary technology, skilled employees, existing customers, regulatory licensing, manufacturing capacity, distribution channels, international operations, and data digital platforms. Now, here's why organizations pursue mergers and acquisitions. The most common strategic rationales include economics of scales. That's spreading fixed costs across larger level of production. Economies of scope. That's using shared capabilities across multiple products or services. Market expansion. Entering a new region or customer segment. Product expansion. Adding complementary offerings. Technology acquisition. Obtaining innovation faster than developing it internally. Talent acquisition. Securing employees with specialized knowledge. Vertical integration. Gaining greater control over suppliers, production, or distribution. Diversification. Reducing dependence on one industry or market. Competitive positioning. Responding to consolidating by rivals. Financial restructuring. Using debt, tax advantages, asset sales, or other financial mechanisms to improve returns. These rationales may sound convincing, but managers must distinguish a strategic argument from evidence that the transaction will create value. Okay, now let's talk about why mergers and acquisition activity occurs in waves. M&A transactions are not evenly distributed over time. Periods of unusually high deal activities are often described as mergers in waves. Economic research recognizes that major mergers surge around the turn of the 20th century. The 1920s, the 1960s, the 1980s, and the 1990s. Researchers have connected these waves to changes in technology, capital availability, economic conditions, industry restructuring, and opportunities to reallocate corporate assets. Conditions that commonly encourage a merger wave include strong economic growth. When corporate profits and expectations are rising, executives and investors may be more willing to approve expansion. High stock market valuations. A company with high valued shares can use its stock as acquisition currency. A buyer may issue shares rather than pay the entire purchase price in cash. Accessible credit. Low interest rates, active bond markets, and willing lenders make it easier to finance acquisitions. Technological disruption. Major technological changes can force companies to acquire new capabilities or combine with firms that possess them. Regulatory change. Deregulation may remove barriers that previously limited combinations. Stronger enforcement can have the opposite effect or encourage firms to develop new transaction structures. Industry shocks. So, recession, commodity price changes, capitalization, supply chain disruption, and changing consumer behavior can make some firms vulnerable and others acquisitive. Managerial imitation. When several competitors announce acquisitions, executives may fear that remaining independent will leave their firms too small or strategically disadvantaged. One theory of merger waves suggests that managers may acquire because they fear their own companies will otherwise become takeover targets. So here's why managers need to understand merger waves. A wave can create pressure to act quickly. However, widespread deal activity does not prove that a particular deal is strategically sound. Managers should ask, are we acquiring because the deal supports our strategy? Are we reacting emotionally to competitors? Are rising valuations causing us to overpay? Are financing conditions hiding the true risk? Would partnership licensing, hiring, or organic investment accomplish the same objective? Are we entering the transaction near the peak of an economic cycle? Well, history shows that companies frequently complete expensive acquisitions shortly before economic or technological conditions change. Let's talk a little bit about the major historical merger waves. Scholars differ from somewhat in how they date and number the waves. The following framework presents the commonly recognized U.S. pattern and the major strategic logic associated with each period. Wave 1. Horizontal consolidation and the creation of large industrial enterprises. That approximate period was 1890 to 1904. The first major U.S. merger was followed rapid industrialization, expansion of the railroad system, development of national markets, and increased manufacturing capability. Many combinations were horizontal mergers. A horizontal merger joins companies that compete at the same stage of production and sell similar products or services. Examples of industries affected included steel, oil, tobacco, sugar, mining, railroads, chemicals, and manufacturing. The objective was frequently to combine numerous competitors and establish dominant control over an industry. Historical economic research found that a small group of industries accounted for a substantial share of merger activity between 1895 and 1904. For example, U.S. Steel. U.S. Steel was formed in 1901 through the combination of the Carnegie Steel and other steel operations. It became an early example of large industrial corporations created through consolidation. The strategic logic included a combination of production capacity, reducing competition, coordinating prices and output, improving access to raw materials, achieving national scale, and increasing bargaining power. Let's talk about the legal environment. The Sherman Antitrust Act was enacted in 1890 to protect competition and address monopolistic conduct. Businesses subsequently adapted their organizational methods, and first great merger wave developed during the 1890s. The Sherman Act initially focused more directly on agreements and monopolization than on the full range of corporate acquisitions. This left room for firms to replace cooperative arrangements, trust, or cartels with permanent corporate combinations. Here's what we need to learn from this first wave. Managers should recognize that the scale can create efficiency, but it can also create market power and regulatory risk. The critical distinction is between becoming more efficient because operations are combined, or becoming more profitable because competition has been weakened. Managers must understand that regulators may view market share, competitive alternatives, entry barriers, and control of essential assets differently from corporate leaders who are primarily focused on growth. Now let's talk about wave number 2. This is vertical integration with the rise of oligopolies. Hard word. Approximate period of time was 1916 to 1929. The second wave occurred during and after World War I and continued through much of the 1920s. Where the first wave emphasized horizontal consolidation and monopoly formation, the second featured more vertical integration and combinations that created industries dominated by several large companies. So, vertical integration is a vertical merger that combines companies operating at different stages of a supply chain. A manufacturer might acquire a supplier of raw materials, a transportation company, a wholesaler, a retailer, a distributor. Some strategic rationale of vertical integration that can provide greater supply security, better quality control, lower transaction costs, improved production coordination, protection from supplier price increases, direct access to customers, control over distribution, and reduced dependence on outside firms. Now, there is some risk of vertical integration. Vertical ownership can also create rigidity. A firm may become committed to an outdated technology, an inefficient supplier, a high-cost distribution system, assets that competitors can obtain more cheaply from the market. Vertical combinations can also create competition concerns when a company controls an input, platform, distribution channel, or customer access point needed by rivals. So in 1929, there was a collapse. The stock market crashed, and the Great Depression sharply reduced transaction activity. Financing became difficult. Corporate values failed, and managerial attention shifted from expansion to survival. Here are some lessons from this second wave. Control and ownership are not always the same as strategic advantage. Managers should compare acquisition and alternatives such as long-term contracts, strategic alliances, joint ventures, licensing, multiple for sourcing, and franchising. Owning more of the value chain may improve coordination, but it also increases capital requirements and organizational complexity. Okay, let's talk about wave 3, which is called conglomerate expansion. And the approximate period was the mid-1950s through 1969. The third wave became known as the conglomerate mergers. A conglomerate combines businesses operating in different industries or product markets. So, why do conglomerates become attractive? During this period, regulatory policy made some horizontal combinations more difficult. Companies seeking continued growth began acquiring firms outside the core industries. Executives also believed that professional management systems could be applied across diverse businesses. Corporate headquarters could supposedly improve performance through capital allocation, financial controls, strategic planning, management development, centralized analysis, and portfolio diversification. The managerial philosophy was that conglomerate leaders often believed that a talented executive team could manage almost any kind of business. The corporation itself became a portfolio of business units. This reflected a strong faith in quantitative planning, centralized control, financial performance measures, management expertise that could transfer across industries. So an example is ITT. The International Telephone and Telegraph became associated with conglomerate expansion by acquiring businesses in the industry far removed from telecommunications. So an example of that is Penn Central. In 1968, a merger of the Pennsylvania Railroad and New York Central created Penn Central. The company entered bankruptcy in 1970. Its difficulties included compatibility systems, operational problems, cultural conflict, industry decline, and an inability to achieve the expected integration benefits. So, let's talk about why many conglomerates struggled. Diversification can reduce exposure to one market, but it does not automatically create operating value. Common problems included headquarters that lacked industry expertise. Business units had little operational connection. Reporting systems emphasized short-term financial results. Complex structures hid weak performance. Managers overestimated transferable skills. Capital was allocated politically rather than strategically. Corporate size exceeded leadership capacity. The managerial lesson from this third wave is that diversification must create more value under common ownership than the businesses could create independently. Managers should ask these questions. What capabilities can actually be shared? Why are we a better owner of this business? Can investors diversify more cheaply on their own? Does headquarters add expertise or merely cost and bureaucracy? Are we acquiring growth because the core business has stopped growing? A collection of unrelated businesses is not necessarily a strategy. Okay, let's shift gears and talk about the development of modern U.S. merger regulation. The history of M&A is closely connected to the history of antitrust policy. The Sherman Act of 1890 was the first major federal antitrust statute. It addressed restraints of trade and monopolization. The Clayton Act of 1914, Section 7 of the Clayton Act, addressed acquisitions whose effect may substantially lessen competition or tend to create a monopoly. The important word is may. Merger enforcement is preventative. Regulators do not always need to wait for consumer harm to occur after a deal closes. The Seller-Kaffer Act of 1950 amends the strengthened Section 7 by extending merger review to asset acquisitions and combinations involving firms that were not necessarily direct horizontal competitors. This development was important because companies had found ways to structure transactions that avoided earlier restrictions. The Hart-Scott-Rodino Act of 1976. This was an act created a pre-merger notification system for transactions meeting applicable thresholds. It allows Federal Trade Commission and Department of Justice to examine many large transactions before they close. Before the system, the government could be forced to challenge an already completed transaction. separating businesses after systems, facilities, employers, and customer relationships that have been found combined. This can be extraordinarily difficult. So, let's talk about why managers must understand the regulatory process. Regulatory review affects deal timing, transaction costs, confidentiality, financing commitments, integration planning, divestiture requirements, contract provisions, employee communications, closing probability. Managers should never assume that legal review is merely the responsibility of attorneys. Operational leaders may need to explain market structure, customer alternatives, supplier relationships, pricing authority, capacity constraints, entry barriers, product substitution, data control, and distribution access. Poorly written internal documents can also create risk. A presentation describing a deal as a way to eliminate competition may control prices or lock out rivals may become significantly evidenced through regulatory review. So in 1968, there were some merger guidelines. The Department of Justice issued its first merger guidelines in 1968. These guidelines reflected a relatively strict approach to market concentration. In 1982, merger guidelines presented a major shift. The central concern became whether a merger could create or enhance market power or facilitate its exercise. Market power refers to the ability to raise prices above competitive levels, reduce output, weaken quality, and otherwise diminish competitive conditions. The 1982 framework also helped establish hypothetical monopolistic approach to defining relevant markets. There's some managerial significance. This change encouraged managers and regulators to move beyond the simple question of how large will the combined firm be? The analysis increasingly considered market definition, substitutes, customer behavior, entry, efficiencies, competitive effects, and market power. Size alone does not determine whether a merger is harmful, but neither does an efficiency claim automatically justify increased concentration. Okay. Now let's talk about wave number 4, hostile takeovers, leveraged buyouts, and corporate restructuring. And the approximate period was 1981 to 1989. The fourth wave differed sharply from the conglomerate era. Instead of assuming that larger diversified corporations were automatically superior, acquirers increasingly argued that many large companies were poorly managed, inefficient, and undervalued. Some defining features included hostile takeovers, leveraged buyouts, divestitures, breakups, corporate raiders, high-yield debt, managerial buyouts, and aggressive restructuring. A hostile takeover occurs when an acquirer attempts to gain control without support from the target company's board or senior leadership. The buyer may make a tender offer directly to shareholders, seek to replace board members, accumulate shares, use public pressure, or propose a competing slate of directors. In a leveraged buyout, a substantial portion of the purchase price is financed with debt. The acquired company's assets, earnings, and future cash flows help support repayment. Strategic logic. Supporters argued that leverage transaction could discipline inefficient management, sell underperforming assets, reduce unnecessary corporate overhead, focus the company on core operations, improve accountability, increase management ownership, and/or generate strong cash discipline. But there are some risks. Debt can improve discipline, but it also reduces flexibility. A highly leveraged company may have less capacity to invest in research, survive a recession, respond to competitors, maintain employment, replace equipment, absorb operational problems, and support long-term innovation. There are some managerial lessons from this fourth wave. Capital structure changes organizational behavior, and managers need to understand debt capacity, interest coverage, cash flow viability, asset sell assumptions, convenient restrictions, refinancing risk, effects on employees and suppliers. A company can be strategically promising, but financially overburdened. In the fifth wave, globalization, strategic mega mergers, and technologies boom. And that period is 1993 to about 2000. The fifth wave was supported by economic growth, globalization, deregulation, rising stock prices, technological change, and abundant capital. Many deals were presented as strategic combinations and intended to transform industries. Some predominant sectors included telecommunications, banking, energy, media, pharmaceuticals, technology, financial services, and automotive manufacturing. One example is Exxon and Mobil. The ExxonMobil transaction combined two major petroleum companies. The FTC required extensive divestitures to address competitive concerns, including approximately 2,431 gas stations, a California refinery, pipeline interests, terminals, and other assets. It was described at the same time as the largest retail divestiture required by the FTC. The managerial lesson from ExxonMobil? Regulatory approval may significantly change the economics of a transaction. Managers must model not only the original deal, but also possible remedies, which includes assets that might have to be sold. Will the buyer lose valuable geographic coverage? Could required divestitures reduce expected synergies? Can operations be separated cleanly? Will competitors purchase the divested assets? And does the transaction still create value after these concessions? Here's another example, AOL and Time Warner. AOL and Time Warner announced a landmark combination at the height of the internet boom. The strategic thesis was that AOL's internet access and digital reach could be combined with Time Warner's content and cable distribution. The FTC approved the deal subject to conditions intended to prevent the combined company from limiting access by competing internet service providers. The order required the company to provide access to unaffiliated broadband providers and prohibited discriminatory treatment of certain content. The broader business combination later became a classic warning about paying with highly valued stock, overestimating digital convergence, cultural incompatibility, weak integration, rapid technological change, and declining assumptions after a market bubble. The manager lesson about AOL Time Warner is that strategic logic must be tested against execution reality. Managers should distinguish among a compelling narrative, theoretical possible synergy, a measurable operational plan, and finally, a synergy that can be captured within a realistic period. The words digital transformation, convergence, platform, and ecosystem can make a transaction sound modern. They do not prove that customers will behave as predicted, that the organizations can integrate. The post-2000 period, which includes private equity, global deals, and crisis-driven consolidation. Following the collapse of technological bubble, deal activity declined. It later recovered as credit markets expanded and private equity firms became increasingly influential. The private equity expansion sponsors raised investment funds and used combinations of investor capital and debt to acquire companies. The private equity model often emphasizes operational improvement, management incentives, financial restructuring, asset sales, add-on acquisitions, and eventual resale or public offering. A private equity sponsor may acquire a central company called a platform and then purchase similar companies to add customers, geography, talent, or specialized capabilities. This is sometimes called a buyer and build strategy. The managerial concern is that repeated add-on acquisitions can create hidden integration complexity, and a company may grow rapidly while accumulating multiple pay systems, different operating procedures, inconsistent compensation, fragmented cultures, incompatible technologies, uneven customer experiences, and weak internal controls. Growth in revenue does not automatically mean growth in organizational capability. In 2007 to 2009, there was a financial crisis. The global financial crisis sharply reduced conventional mergers and acquisition activity because credit contracted. Asset values became uncertain, banks faced severe financial stress, and buyers had difficulty financing transactions, as well as regulators focused on system stability. At the same time, the crisis produced emergency and distressed combinations. These transactions were often motivated less by growth than by survival, stabilization, or the transfer of assets from failing institutions. The managerial lesson from crisis-era deals: the purpose of an acquisition changes during distress. A buyer may gain an attractive price, but also inherit unknown liabilities, weak controls, regulatory exposure, damaged customer trust, employee instability, problem assets, and litigation. Speed may be necessary during a crisis, but rapid execution increases the importance of scenario planning and post-closing risk containment. In the 2010s, platforms, data, capabilities, and industry convergence are considered. During the 2010s, acquisitions increasingly focused on intangible assets. Traditional transactions often targeted factories, real estate, equipment, and distribution capacity. More recent transactions frequently targeted software, patents, algorithms, customer data, digital platforms, user networks, engineering talent, artificial intelligence capabilities, and intellectual property. Let's talk about acqui hiring. And acqui hiring occurs when a company acquires another organization primarily to obtain its employees. The acquired product may be discontinued, but the technical team joins the buyer. Platform economics. Digital platforms may become more valuable as more users, sellers, advertisers, developers, or service providers participate. These network effects can make platform acquisition strategically important. However, managers must understand that value may depend on retaining users, developers, data access, trust, key employees, and complementary businesses. The managerial lesson is that intangible assets can disappear rapidly after an acquisition. A factory remains physically present after closing. A software development team can resign. Customers can leave. A platform can lose relevance, and data can become restricted by law or policy. Managers therefore need retention plans, cultural sensitivity, and clear integration boundaries. Okay, now in more modern day, let's talk about the pandemic period and its aftermath. The COVID-19 pandemic initially disrupted mergers and acquisitions because of uncertainty and operational constraints. It also accelerated changes in e-commerce, digital communication, remote work, health technology, logistics, cloud computing, streaming, and supply chain strategy. Organizations acquired companies to gain capabilities that had suddenly become strategically urgent. There is some strategic danger. Managers may confuse a temporary behavioral shift with a permanent structural change. A business experiencing rapid pandemic-era demand may be valued as though exceptional growth will continue indefinitely. If demand normalizes, the acquirer may discover that it purchased at the top of the market. So the managerial lesson is that valuation must separate sustainable earnings, temporary demand, one-time cost reductions, cyclical growth, and structural market change. Historical results need to be normalized before managers forecast future cash flow. Okay, now let's talk about reoccurring strategic patterns across mergers and acquisition history. Although industries and technology change, several patterns repeatedly appear. Pattern 1. New technology encourages consolidation. Railroads, mass production, telecommunications, the internet, cloud computing, and artificial intelligence have influenced corporate combinations. Managers often acquire because internal development appears too slow. The risk is that the buyer may misunderstand the technology, overpay for growth, lose acquired talent, integrate too aggressively, and purchase capability that becomes obsolete. Pattern 2, easy capital increases transaction volume. When financing is inexpensive, more deals appear financially attractive. However, low financing costs can encourage excessive leverage, higher purchase prices, weak due diligence, optimistic forecasts, riskier targets. Pattern 3, regulation affects deal structure. Companies adapt to antitrust laws, tax law, security regulation, industry rules, and international review. Regulation may not eliminate mergers and acquisition activity. It may redirect it toward different industries, smaller transactions, asset purchases, joint ventures, vertical combinations, conglomerate expansion, and cross-border deals. Pattern 4. Strategic fashion influences managers. Each era has its preferred language: trust, consolidation, vertical integration, conglomerate, restructuring, globalization, convergence, platform strategy, digital transformation, and artificial intelligence. Mergers need to test whether the terminology describes a real source of value or merely reflects the popular management narrative of the period. Pattern 5. The integration determines whether projected value becomes real. Deal approval is not the same as deal success. A transaction may be strategically logical and still fail because of cultural conflict, leadership turnover, poor communication, customer attrition, technology incapability, delayed decisions, unclear accountability, and unrealistic synergy targets. So let's talk about why managers need to understand mergers and acquisition history. History improves strategic judgment. Managers who know previous manager cycles can recognize when executives are repeating familiar assumptions. Examples include, we must buy before a competitor does. The acquisition will transform the company. The cultures are similar enough. The synergies will pay for the premium. The target will continue growing at its current rate. And the integration will be straightforward. Each statement requires evidence. History improves risk recognition. Historical cases show that risks are interconnected. An overvalued acquisition may lead to excessive goodwill, pressure to cut costs, employee departures, reduced investment, customer dissatisfaction, and future impairment changes. The purchase price influences post-merger behavior. History helps managers evaluate synergies. A synergy is additional value expected from combining companies. Cost synergies include elimination of duplicate facilities, consolidation of purchasing, reduced administrative expenses, shared technology, combined distribution. Revenue synergies include cross-selling, new markets, expanded product bundles, increased customer retention, new pricing opportunities. Revenue synergies are often harder to achieve because they depend on future customer behavior. And managers should ask, who owns each synergy? What investment is required? When will it occur? What could prevent it? Will achieving it damage revenue or morale? Is it already reflected in the purchase price? So, history strengthens due diligence. Due diligence should investigate more than accounting records. Managers need to examine strategy, customers, operations, technology, cybersecurity, talent, culture, regulation, litigation, environmental exposure, intellectual property, supply chain, and ethics and compliance. History reveals the importance of timing. A good company can be a bad acquisition at the wrong price. A strategically sensible deal may destroy when value is at a premium. Financing is too risky. The industry is near cyclical peak. Technology is changing too quickly, or management lacks integration capacity. History can help managers challenge groupthink. During a merger wave, questioning the deal may be interpreted as resistance. Effective managers must create a space for constructive management, and organizations should use independent valuation, scenario analysis, pre-mortem exercises, red team waves, clear walkaway criteria, board-level challenge, and integration readiness assessments. A managerial framework for studying any historical deal is important. When examining a merger or acquisition, managers should analyze 7 areas, including historical context. What was happening in the economy? Was the industry growing, declining, or consolidating? And what technology or regulatory changes were underway? Strategic rationale. What problem was the transaction intended to solve? Why was acquisition preferred over organic growth or partnership? Transaction structure. Was the deal paid for with cash, stock, debt, or a combination? Who obtained control? What premium was paid? Stakeholders. How were stakeholders, employees, customers, suppliers, communities, and regulators affected? Integration. Which systems, leaders, brand, and operations were combined? What was deliberately kept separate? Outcomes. Were the projected synergies achieved? Did market share, profitability, innovation, customer value improve? Did debt, turnover, or regulation exposure increase? Finally, counterfactual. What might have happened without the transaction? Could the same objective have been achieved through a less risky alternative? Here are some key takeaways. Mergers and acquisition evolve through distinct periods, but several central ideas remain consistent. M&A is a method of obtaining growth, resources, capabilities, talent, customers, or market positions more quickly than internal development. Merger waves were influenced by economic growth, technology, capability, availability, regulation, managerial limitation, and industry disruption. Early merger waves emphasized horizontal consolidation and vertical control. The 1960s featured conglomerate expansion based on the belief that professional managers could create value across unrelated businesses. The 1980s emphasized hostile takeovers, leverage, restructuring, and the discipline of underperforming management. The 1990s emphasized globalization, deregulation, strategic mega mergers, and technology-driven convergence. The more recent activity has increasingly emphasized software, data, platforms, intellectual property, and specialized talent. Antitrust laws evoked a response to changing corporate structures and competitive concerns. The Sherman Act, Clayton Act, Cellular Cover Amendments, Hart-Scott-Rodano Act, and successive merger guidelines all influenced how transactions were evaluated. A persuasive strategic rationale does not guarantee successful execution. And finally, managers must understand how history, because many contemporary acquisition mistakes are variations of mistakes made in earlier merger waves. So there you go. This is the first video on mergers and acquisitions. I hope that you have learned something that you can take away from this to help you become a better manager. And more importantly, I hope that you have a great day, because only you get to choose how you feel about it. I'm Dr. Paul Gerhardt.